What's up, everybody? Joe Brown here. This is Heresy Financial. Many of you have pointed out the Federal Reserve's balance sheet, and this made rounds 2 weeks ago when the Federal Reserve's balance sheet expanded rapidly, especially at the end of the year when the Federal Reserve had been giving so much lip service to tapering their purchases. And so today I'm going to answer the question for you. Is the taper already over? Is it all words and no action? Or what is actually going on here? Ready? Let's dive in. So is the asset purchase taper already over? Well, let's take a look at the numbers to see exactly what is going on. First of all, I want you to notice when we look at the Federal Reserve's balance sheet, you can see that it goes up and then down and then up and then down and then up and then down over time, creating a very, very consistent trend upwards. And during the last 15 months before the taper started, you saw an average increase of about $115 billion every month when they were targeting about $120 billion. Keep in mind, some weeks they're selling, some weeks they're buying, some weeks it's relatively flat. There's a cycle that they go through where they're doing buying and selling, consolidation, adding, and over time it was about $115 billion. Now, over the last 2 months, when they have already started the taper, what has their balance sheet increased by? If you take what the balance sheet is at their most recent update, go back 2 months from there, we can see everything that happened in November, everything that happened in December, and we can see that during this time, their balance sheet increased by just about $200 billion. Over 2 months, that's an average of $100 billion per month. Is that a taper? Well, they were doing 115 to 120 billion before. Now, over the last 2 months, they've been doing 100 billion. That is the definition of their current taper. Right now, they're reducing their purchases. They've already said in January through March, they will be accelerating the pace at which they reduce their asset purchases so that by the end of the March, they're done buying assets. That means that when you look at their balance sheet post-March, what you're going to notice, it'll go up and down, but it'll be moving sideways instead of net up. Following the flattening out of their balance sheet, once they have stopped on net purchasing assets, they're going to start raising interest rates. I want to explain there what I mean though by on net. They're still going to be buying treasuries to replace the ones that mature. They're not going to let their balance sheet just run off. As the federal government pays them back the money that's due as it comes due, they're not just going to accept those dollars and be done with it. They're going to take those dollars, turn right back around to the open market and buy more government debt with those dollars. This way their balance sheet stays the same. This way, any amount of government debt that is held on the Federal Reserve's balance sheet doesn't actually need to get repaid by the government, because every time they repay $1 billion here, $1 billion there, they're getting a new loan from the Fed for the exact same amount of money. This means that if the Federal Reserve's balance sheet was flat and they held all $28 trillion worth of government debt, the government wouldn't actually have any debt payments whatsoever, because every time one of their loans matured, they'd get a new loan of the exact same amount, even if the Federal Reserve's balance sheet was staying the same. Now you might ask, well, what about interest payments? Because interest payments are a big part of that. Any interest that the federal government pays on its debt to the Federal Reserve for the debt that the Federal Reserve owns, for the debt that the government owes to the Fed. After the Fed pays for its expenses, all profits are swept back to the Treasury. This means that for a thought experiment, if all $29 trillion or $28 trillion of government debt was owned by the Federal Reserve, it would be essentially interest-free debt. The only cost would be the costs of running the Federal Reserve. All the other profit is swept back to the Treasury. So both maturing and interest payments really on net, just an accounting thing, because it's all coming back to the Treasury after it leaves. So people still say I'm crazy. People still say I'm wrong. All I'm doing is looking at what the Federal Reserve is actually doing. And so far, they are still tapering like they said they would. And my guess is they will continue to taper and stick to their plan until they spark a crash. Once a crash starts, then they'll reverse course, then they'll change their tune. But as long as the data stays the same, as long as we still have inflation and we don't have a crash start, they will continue to taper until they cannot do so any longer. As always, really appreciate you guys. Thanks for watching.